Rahul, fantastic to have you back. Thank you for joining us. Let me just wait to see Rahul's video, because last time when we had Rahul on the channel, he was looking very, very different. So is it back to normal Rahul Bhasin, or Rahul, you're still maintaining the quarantine look? Slightly different, slightly different.
Look, but I think your troglodyte or caveman look has been somewhat muted, courtesy my children.
Good to have you back, Rahul. It's one of those phases in the market where the naysayers are getting challenged, and the naysayers are insisting these are not fundamentals, this is liquidity. Markets are going higher because of liquidity. What do you have to say to those?
So look, liquidity is also a fundamental. I don't think we can avoid that fact. I mean, the bottom line is that markets will discount, future cash flows. And if your discount rate is lower, the value of the future cash flows is going to be higher. I mean, that's just basic finance 101. I mean, you can't get away from that fact, right? I think the argument for those who want to say that the markets are overvalued is to say that, the discount rate is artificially suppressed and is not the normal. And therefore, if the interest rates were back to the normal levels which they should be prevailing given inflation, etc., then maybe markets are too high. But to them, I would sort of say that, ultimately, you have to look at asset classes relative to each other. There is no such thing as an absolute valuation. If you look at the bond markets and you look at where equity markets are relative to the bond markets today, I think the equity markets are just fine. There's nothing, it's not because you also, besides looking at normal inflation, then one should be looking at normal earnings. I mean, because you don't value a business on the basis of 1 quarter or 1 year's earnings. You look at the earning generating capacity of a business. And I think that the earning generating capacities of businesses, more than that, I think because of the downturn in Capex that we've had since, I think, 2013, early 2013, you had this, fall off in Capex and a struggle to sustain growth. You actually had a lot of incremental reform which has crept in over the years. And I think that a lot of that is increasing productivity, increasing competitiveness of Indian business, and is therefore going to increase and improve the cash flows sustainable. Also, if you look at the world today, I mean, whether you like it or not, I mean, the world is generally very unhappy with China. It is a very dominant, it has 25% of the world manufacturing share. And I can see very clearly that, from one large corporation to the next, people want to reduce their dependence on China. They want alternative supply chains. And I think that for multiple reasons, in spite of the fact that we have a lot of issues in terms of our, the implementation and execution of tax policy, etc., which has been a challenge for foreign investors. In spite of all of this, I'm seeing more and more proclivity of global players to, diversify their supply chain into India. And I think that's going to benefit and create demand, going to benefit a whole host of ancillary industries and give rise to a lot of businesses. So I, for one, am a big bull on the India 10-year, 20-year story.
Rahul, up until now, for those who've made investments, firms like yours, in IT, pharma, perhaps knowledge-based sectors, they've made money. Because in India, like you pointed out, Capex and industrials, those sectors have gone through their own period of challenge. But of late, the news from, let's say, an Ultratech, or from Tata Steel, from an Hindalco, seems to be indicating that the Capex cycle has started. Do you expect that the market also will now start turning and we could see a complete reversal of what may happen in terms of outperformance and underperformance?
Well, yes, I think that there have been sectors which have been beaten down for so long. Like I said, I mean, it's been 8-9 years and they've been underinvested in. New capacities haven't come up. Cement is only one of them. I mean, you look at most of the engineering value chain, etc., you'll find something very similar going on. And we are reaching points where, forget about incremental demand, I think there is now replacement demand has kind of picked up and gotten up to the level of where capacities exist. So you will see cyclical change in these sectors, and you will see price rises, which will be a prelude to Capex. People will not do Capex unless they meet certain return on capital employed numbers and thresholds. And I think for that, in a lot of commodity-related sectors, you'll see price increases. And guess what? The last 3-4 months, you've actually seen that. Even things like steel, copper, etc. You're seeing these price increases. You're seeing this flowing to the bottom line, which is why you're suddenly finding this confidence of players in the B2B sectors to suddenly start talking about making incremental investments. And even in that whole pile, I mean, if you look at, cement, etc., sure, there is this whole demand supply mismatch which is taking place. And I think the government correctly, to my mind, is talking about investing more in infrastructure, roads, etc., which I think is the right thing to do, absolutely. But there's also this huge chronic shortage of urban housing, for example. There's a chronic shortage of urban infrastructure, for example. So that demand is pent up, locked up. Plants in the east, especially the northeast, are going to benefit disproportionately because there is very little incremental supply there. But that's just, I think the whole tide is going to go up, and I think maybe some of those players will do better than the others. I think Shree Cement probably also stands out in terms of having the lowest cost of manufacturing and the lowest operating cost and the highest EBITDA margins in the industry.
Rahul, from cement to pockets like real estate, for example, you've been talking about how beaten down sectors are likely to come back, and how there's actually plenty of opportunity, even valuation-wise. Take us through that rationale in a little bit more detail.
I think if you look at something like real estate, it's been a dog sector now for the last decade. What you saw a revival in the last few years was the entire office space sector, right? I mean, largely, I think Bangalore led it, followed by Hyderabad, Chennai, etc. You saw the demand for office space going up significantly. But every time you hire somebody in an office, you create a job, and that creates its own demand in terms of housing requirements for that person, his family, and I think that there's still a catch-up play as far as that demand is concerned. You juxtapose that with the fact that now your borrowing rates are so low. And again, you can see why there might be a push towards trying to fulfill that demand today. I think what is holding the whole market and the whole ecosystem back has been, one, there's been a governance issue with a lot of the players in the real estate sector. But if you look at some of the guys who are still standing today, I mean, the governance is very decent. I mean, whether you look at a Shobha, you look at the Tatas, you look at the Godreges, you look at Oberoi Realty. I mean, there is enough and more players who have good governance who can address these markets. And I think that there is a backlog of demand to be caught up on. So I think that this you will see this inflection point very, very soon.
Fabulous. I also find it really interesting, your point you've made about valuations and how you feel we're not actually overpriced. I mean, would that apply even to some of the pockets that we've seen this phenomenal run-up in? Are you referring to the index? Because while there is still, of course, enough in the market that is relatively cheap, there could be a debate on pockets like a Pharma or Reliance or some of the other heavyweights that have really seen a strong run-up.
That's always the case. You will always have one segment of the market which is overvalued and extremely popular, which becomes the consensus trade. and that's true even today. But my comments are more germane to the wider market. I think that if you look at the mid-caps, etc., I think there is a lot of value there. I think the real issue with mid-caps is, one, liquidity is a big issue, so people need to be very cautious as to how they construct their portfolios given that one risk. But also, I mean, it's very important to distinguish the good franchise mid-caps versus the simple price takers and with no competitive advantage kind of mid-caps. And I think anyone who has the ability to do that, there is plenty of opportunity out there today. Is pharma overvalued at the current juncture? Yes, I believe it is, and I think that it is largely because there's this whole concept that if there's a pandemic, then in a pandemic you need more medicines, and therefore you will end up spending more there. And this is likely to not get hit. And I think there was a bit of a safety trade going on there too. And I think that maybe it got a little overdone. But even in the pharma sector, there are many, many players which I think from a structural basis, very good businesses, very good franchises, and are likely to do well. I mean, again, we own Lupin, but I would say Lupin is a company which is an extraordinarily well-run company, has gone through several sort of negative news and negative news flow and negative sort of expectations in a big overhang the last 2 or 3 years, but that does not diminish away from the long-term earning capacity of the business or the customer franchise or the technology franchise that the company has. So again, out of favor, but the strong business franchise. You'll see a lot of other businesses even in the pharma space, which actually offer you value even today. To my mind, the best opportunities are, of course, not even in the listed markets, but more in the private markets, where people are using the immense amount of patient data which is available in India in various kinds of disorganized forms, organizing it, capturing that and trying to capture insights to improve treatments. And I think that's a tremendous, tremendous opportunity which is out there, which is available to India, where Indian businesses actually have competitive advantage. Whether you look at eye hospitals or cancer hospitals, you'll find that the kind of patient flow that these people have in India, I mean, most Western companies are just dying to partner with this kind of patient flow and patient data. And I think that, again, there is plenty of opportunity for these people to integrate into the global ecosystem, just with making their data available and actually trying to harness and develop superior treatment protocols, etc. I think in India specifically, opportunities which arise, which are not available to a lot of other people, is to use old drugs to repurpose treatments. So therefore, your cost benefit illustration I'm talking about, you find things like the use of aspirin or the use of metformin in cancer treatments significantly improve outcomes in a lot of different cancers. Now, this is not well known. It's something which is coming out from data today. But I'm just using this to illustrate the fact that this kind of opportunity set is massive. There is also increasing evidence that different diets, different foods have very similar mechanisms of actions to different drugs without a lot of the side effects. And again, this is coming out from the use of data and data analytics. And again, the opportunity, given our agricultural and biodiversity in India, is massive for Indian entrepreneurs to try and harness this and take advantage of it.
Sure. Rahul, that brings me to IT, one of your largest holdings as well in the Barings portfolio. Now, we've already seen a massive re-rating in the IT space already take place. In fact, from the March lows, this was the sector which began to move first, and surely, why not? The data points, the commentary from the managements all suggested that IT is the space to be, and post-COVID, in any case, we've seen the world at large turn digital. But what next? Where within IT now do you see a disruption? Is it time to take tactical calls? Do you now bet on bottom-up stories, or do you stick with the leaders within the listed universe?
My view is that both will do well, because if you look at the world and how it's going and how you look at businesses, you're finding that IT is playing a more and more fundamental role across businesses. I mean, if you look at the banking sector, for example, and you look at NBFCs, it's the people who have, are adopting technology, both from a customer acquisition perspective, from an operations perspective, from a risk management perspective, from a credit analytics process perspective. It is these people who are benefiting, and you're finding that it is ultimately becoming a tech play. There are so many businesses where I'm finding it is actually technology which is driving even marketing decisions. I mean, the CMO, the Chief Marketing Officer, his role is looking more and more like the Chief Technology Officers, right? And I think that if you look at the extent to which technology has become ubiquitous in all kinds of aspects of running business, I think that people who are focused on enabling, facilitating, driving this kind of change are going to have a lot of business, at least in my lifetime. So the big ones have enough to do, and the ones who disrupt and use conjunction of domain and IT to get leader beaters.
We seem to have snapped that feed with Rahul. We're going to get back to him in just a second. Tech troubles there. 13,400 staying put for the index right now. 13,426 for the Nifty futures. Good market breadth. Canara Bank holding up 5.5%. Maruti playing solid catch up. It's good to see that all these names that I'm mentioning are seeing a follow through for a second consecutive day, or for that matter third, in cases like a Glenmark moved on Friday, moved yesterday, and today as well it's seeing good price action, or for that matter even Interglobe Aviation, another 2.25% bump up coming in. UPL again a mover yesterday, today as well it moves another 2.5%, and you could add Godrej Properties as well to that book. Tata Chemicals very active yesterday, was one of the big winners. Today as well it's holding up 0.4%, not as strong a move as yesterday, but 511 levels on that one. On the flip side though, what's seeing some profit taking is metals once again. So Jindal Steel is lower as we speak right now. This Coal India, which is down about 1.25%, and Sun Pharma, which was a late entrant to the pharma rally, today that's taking a bit of a pause. But again, what's good is that the losers, and the biggest one, at least within the F&O universe in terms of the price losers, is Jindal Steel, and that's down only 1.25%. So there are no big gashes that you're seeing in the markets right now. And on the gaining side, Can Bank is holding up almost 5.5% right now. So that really shows you the inherent strength in the market. Within the Nifty, like I said, there's UPL, there's Maruti, there's Bajaj Auto, M&M, HCL Technologies, HDFC Life, Ultratech Cement. All of these names are holding up quite smartly. Can we go back to Rahul Bhasin? Okay, still having some tech troubles there. We'll get back to him. No causes of complaint really, Nikunj, and the broadening of the markets, the sectoral churn, that continues to be at play.
Aisha, look, it's a healthy market, and what you want to see is churn. And you're seeing churn because of two factors. One, on the large leadership stock, there is definitely a bent towards the style of the market, which is that even if FIs are buying, instead of buying HDFC Bank, they're buying ICICI Bank. Instead of buying Bajaj Finance, you've come down to other, NBFC stocks now, like Shriram Transport or even Piramal. You're buying cement companies now. Tata Steel cannot move. It's an institutional dominated stock if institutional investors are not there. Also, typically what happens, Aisha, when domestic institutional investors are selling, that's redemption. When you redeem, you take out money and you put it in some other asset class. But I'm getting a sense, looking at what is happening in the retail volumes. You speak to retail brokerages, their volumes are at an all-time high, which means the domestic investors at the DI level or in mutual funds, they're selling but putting money back in individual stocks, or they've decided to trade or chase the momentum here. So that explains that why on a net level, even though you got a fat ISO number which is coming from DI on a daily basis, the collateral damage is not very high because the money is not moving out of equities. It is just moving from a select assortment of mutual fund stocks to some individual mid and small cap stocks. So I think that factor or that churn clearly is at play. But whichever way I cut and dissect, slice or dice, cut and throw it open. What a year it's been, Asha. What a year it's been. I mean, the global equity market cap in a COVID year is at $100 trillion. $100 trillion. Just think about it. This is like real magic which has happened from where we were versus where we are right now. And I'm only talking about the index. That has just been just one of those years of nail-biting returns, extraordinary comeback. The believers have got it right, and the naysayers right now have got eggs on the face.
Yeah, absolutely. And the market is holding up 13,400. Broader markets continue to rebound. I think Rahul Bhasin is back with us. Rahul, I got your views on IT, but just wanted to discuss in light of the Bharat Bandh today. There's been huge criticism, a lot of uproar now building to this nationwide bandh today. Your perspective on the agri reforms and the implications that they would have in the longer run.
So, it's quite interesting. I mean, I read a lot of the commentary and I read the debates and about it, and somewhere I get a little demoralized. The biggest issue of the reforms, these agri reforms, to me is not the fact that they've happened now or there's an attempt to make these changes, but why they didn't happen 20 or 25 years ago. There was very good reason to implement these kinds of policy mixes when we were short of wheat, we were short of grain, we were dependent on the Americans to bail us out, and we were living ship to mouth effectively in the 1960s. But when you have agricultural surpluses, when you've got your FCI having food grain, which is like roughly 3 times what they need or what was envisaged to supply their, it is astonishing that we would give high support prices for different kinds of agricultural goods, which is going waste in the country, which we do not have storage capacity for. And we are spending our money doing these things instead of spending money on building infrastructure, on building granaries and building storage silos. 60% of the irrigation in the country is still rain-fed. I mean, it's such a misuse of priorities that we have followed for the last 20, 25 years. And it is, I mean, I compliment the government that they're making these changes, but I ask the question as to why it's taken so long. And I find it amazing that the opposition has so much to say about trying to say that you shouldn't do this. I mean, the same people who, 5 years, 10 years ago when they were in government said that we should be doing this, but never had the courage to go ahead with it because of their political considerations. To me, it's a bit of a shocker. But what's very important is that if you make this change, the amount of capital you will save, and even to my mind, this whole food distribution system that you have in place in the country, to my mind, most of it can be replaced with vouchers. You don't need to do it because the Food Corporation of India, by their own admission, says that 40 to 50% of the food grains they acquire gets lost. Now, what does lost mean? Nobody knows, but 40 to 50% of the food grains they acquire gets sort of lost. I mean, you can say that maybe rats eat it, or maybe it's stolen, or maybe, there is a discrepancy in weights. And they also admit, I mean, if you look at government audits, they suggest that Food Corporation of India's costs of loading, unloading, etc. are 4 times that of the market. Why do we have such an inefficient market infrastructure in such a poor country? I mean, leave it to the markets. I mean, markets have delivered far better outcomes for everybody concerned than any other system. So I really think that a lot of these bunds, etc., are misplaced. And I think that if you look at, it is Punjab and Haryana where the farmers are impacted by this and they will be driven to change because of this. And they're protesting. I really believe that it requires leadership and collective leadership across party lines and apolitical people to actually explain the importance of not driving national waste and facilitating these changes. So, while I have empathy with farmers because I think they form the backbone of our country, I really think that a lot of this protests, etc., and resistance to this changes